there's one message we could give your viewers. They should be pricing everything in gold, everything. Take a calculator out, divide whatever you want to buy. How many ounces is that costing me? How many micrograms of ounces of gold is that costing me? Because that's going to tell you the truth of this fiat debacle, or of like they're just adding zeros right to the Nasdaq. It's insane.
You guys love when we have Patrick Karim on the channel, and I can't believe that it has been 3 months since he's been on. And he was talking last time about keeping a good close eye on the quarterly closes and exactly what that was going to mean for both gold and for silver. Now, we've just had a quarterly close, so we're going to ask Patrick to interpret what we've just seen. We're also going to take a little bit of a step back, and we're going to look at candlestick analysis, and we're going to give a little bit of background and color to that. So the people who aren't too familiar with technical analysis, charting, graphs, are going to be able to interpret them a bit more and understand more of this conversation. So that bit is specifically for you. We're also going to have a look at the Nasdaq as priced in silver. That's a very interesting chart, and it's not something that we regularly look at. So keep an eye out for that. And we are also going to talk to Patrick about why he believes that we should be pricing everything in gold or silver. Enjoy. Patrick Karim, last time we were talking to you, it was 3 months ago, it was January, and you were getting real excited and telling us to keep an eye on the quarterly closes on gold and silver. And a lot of people have been texting and mailing and commenting, really looking forward to you coming back on for the beginning of this quarter to let us know what's happening on your charts. Quarterly closes, talk to me about them.
Well, we didn't get the quarterly confirmed breakouts. I was looking at the gold to SPX ratio, the gold chart itself, the silver chart. It's not, there's no confirmed breakout on that time frame. You're starting to get some, there's like a weekly breakout we had a few weeks back. It's like kind of a ninja breakout. So it's not a horizontal line breakout where it removes 100% of the doubt. It's a slanted one. So that means the momentum is really starting to slow down, the downwards one, and you're trying to overcome less and less steep angles of breakout lines. And once you break out of a horizontal one, a 180-degree one, those are the ones that you break out, you retest, but you don't make a new lower low, and then you just shoot up. We are not quite there yet. So I have a feeling, and I had some longer-term charts like the semestral close, H1 close, that's going to be in June, which will also be Q2. So it's possible now that gold's waiting for semestrial, quarterly, and monthly June close to really confirm that wide spectrum of time frames there before it goes up. But
so getting all those time frames to align. Maybe you might pull up a chart so we can have a look at it, so we can get a visual picture of exactly what's going on. And this is what you always talk about when it comes to fundamentals versus technicals, because everybody's been getting very excited about the gold at the moment. And I suppose rather than saying getting very excited about gold, there's a lot of people that are moving their money out of deposit accounts in banks because they're worried about what's going on with the financial system and moving it into gold. And that's underpinning a lot of the move higher that we're seeing now in gold. Would you agree with that?
Well, there's definitely, look, if the price is going up, no matter who's buying, who's selling, that means there's more buyers than sellers and the price moves up, right? So without having to think who's moving what, because you might be aware of these big funds that are moving money there. Maybe somebody else is aware of some other fund that's removing funds from the precious metals. But we're so lucky we have price charts. So the aggregate of all these market participants with their billions and trillions of dollars each one, it's in the price chart, right? So if you're creating higher lows on the price chart and higher highs, then that's all we need. Look, this, I love this chart because this one is the Sprott physical gold and silver fund. So it's a combination of gold and physical holdings. And you'll see that it kind of hybrids both, right? So we know gold at all-time highs already, but this fund is slightly lower because it has that silver weighting that brings it down a little bit. But what's happening now, both of those metals, the precious metals, 1, 2, 3, 4, 5, 6, 7 touches, that trend line, that's a 12-year breakout line. That's right there for the taking. So yes.
And that's the quarterly again, Patrick, is it?
This one, no, this one's a monthly.
A monthly, okay.
I could go on the quarterly.
No, that's
also,
grand. But the point you're making, and you've made it before, is you sometimes like to see these prices bounce off these lines because it gives more credibility
yes,
to that trend line. So therefore,
yes.
when we actually see a break, it's more likely to be a sustained break. And
That's all it is. Sometimes I see people, they draw trend lines. There's only 2 dots. That's nothing. 3 dots, three reactions minimum. And the more you get, the more valid it is. Look, you'll see here that massive bear market base here. 1, 2, 3, 4. And then we broke out in June or July of 2019. That's weighing the probabilities, understanding the probabilities of that possible upwards move. Once you understand the validity of this base, this is priceless. It goes up, but the sellers are coming in. You're not quite ready to get reevaluated higher. We're going to stick you like that magnet. See all that volume here? That's all these transactions that happen in that base. Like, it's fair market value. People, you're not ready. You're not ready. But once it detaches itself from that magnet base, it's going to shoot up and it's going to try to find another magnet area where, okay, the market says, okay, let's reevaluate. Let's see how much you've appreciated. And that's where we are now. So now we have all these touches. And because we didn't have a confirmed breakout, Dave, it doesn't mean it's bearish. It just means we're consolidating some more, but we're closer to breaking out than breaking down. So right now, yes, of course, it could go down a little bit up. We're getting squeezed by, I think that's a 7-year moving average. This is uber bullish. But if you want to reduce opportunity cost, all you have to do is wait until that line closes convincingly above this paradigm shift breakout line. And then you have a higher probability of having a sustained move in your favor, right? It's this stuff should be giving shivers to everybody watching this unfolding in front of our eyes, right? It's like,
are we going to see? We see now if we do get that breakout, and we get that breakout. Obviously, we're looking at a monthly here, but over there, we'll talk to you again in another 3 months. So we'll keep an eye on these charts as well. If you get a breakout on this chart, what's the type of run that you're looking for? I know that you are hugely bullish from a technical analysis, from a charting point of view, on both gold and silver. Tell me, why is it that you are that bullish on both the metals? Looking at your charts,
well. Okay, so the charts themselves, they're going to present a nice opportunity with technical analysis. They have their bases, their measured moves. But got to take a step back. If you want to add evidence to the macro landscape that gold and silver will have tailwinds instead of headwinds, you could just do this chart that I did today. This is the purchasing power, 100 years of purchasing power. So it's that thick red line. Your purchasing power has just been going down and down for over 100 years. And here's the gold chart, the oil chart, which tracks inversely, practically the same. You could also say oil is a unhedonic adjusted CPI. Oil is energy, is the destruction of your purchasing power element, right? So the higher the energy cost, the more it destroys, it saps away from your purchasing power because everything costs more, right? So that's why it's like a perfect reciprocal inverse. Here below, I have the 4-year rate of change.
And what you mean by that when it comes to oil is, you know, we require energy to make everything that we have and use in our lives. So as the price of oil over that period of time continues to ratchet higher, that eventually filters into everything that we purchase.
Everything, Dave. And so by knowing that, so now if you know the purchasing power is about to crumble, here is the 4-year rate of change of the purchasing power. That red line here is the neutral line. So if you're above here, that means the purchasing power is actually going up. So that's what happened in the Great Depression. When there's recessions, the cost of everything goes down. So your purchasing power, or the dollar, there's a debt destruction. So the dollar appreciates. There's less dollars running after the same amount of goods, right? Or gold. You have this was beautiful. This was a gain in purchasing power. But since 1941, never has the 4-year rate of change of purchasing power ever gone positive. So that means no matter when you've bought your purchasing power, your US dollar, it's never got positive. It's always had bear market rallies, but always in negative territory. Here's the 1966 breakdown. And once it closed below this line, oil I don't know. You could do the chicken and the egg. Is your purchasing power going down because oil is going up, or is it oil going up because your purchasing power is going down? But either case, they're both mirror images. And we're right back here. Look, this is a 38 topping structure in purchasing power trying to climb up. It is climbing up. It gets very close to going positive, the 4-year of change. You can't do it. And now one touch, two touch, three touch, breakdown. And I could have zoomed in on this. That's a bear flag that's actually breaking down. So it's pulling back up. And then it's already has a monthly close. It's already breaking down. And that's the exact same level as 1973 when oil just rocketed, when silver just went bonkers. So the purchasing power is going down the tubes. It could tell you that oil is going up, or the market's pricing oil to go up. Sometimes, you know, the price of this stuff discounts ahead of time. By the time the purchasing numbers come out, like this is the Fed that creates this US purchasing power index. So by the time they get the numbers, it's probably already, oil's probably sniffed out. And all this was a massive gold and silver bull era. Here was the 2000 to 2008, gold and silver went bonkers. So even if oil purchasing power reflated a little bit, gold and silver still did great from 2009 to 2011. But man, this is a huge, huge base that's breaking out. So I can't even put numbers on this. It's oil should just go bonkers right now. It's like oil's going to go up, purchasing power is going to go down the drain, and gold and silver, especially gold, will store that purchasing power destruction, will store it and reflect how much your dollars are going down in value. Gold will just appreciate. It's not going to make you a billionaire. It's just going to, holding an ounce of gold will just protect your purchasing power over time as they keep adding zeros to whatever it is, right? It's like,
so
who
this
cares
is
if the Nasdaq,
yeah, this is pointing at then this is significantly higher oil prices, significantly higher inflation. And as you're describing it there, that's for gold and silver that they're kind of quasi stores of energy, because if oil's going significantly higher, there's a huge amount of energy required to actually get gold out of the ground. That filters back into the price of gold, because when the people who are mining it and paying to mine it are going to be looking for higher prices for it.
It's gold's, it's like it stores that energy, all that energy from oil. It stores it into that physical item you could put on a shelf, but that's stored energy, stored value. It's there, and you could reuse it some other time to buy whatever goods later on, right? For the same amount of ounces. No matter, who cares about fiat? They could keep adding zeros to fiat. I don't care anymore. People have to stop looking at their portfolio and saying, "Oh, I made 20% nominally." Yeah. Okay, well, gold went up 20% this year. You made zero. You made zero because you went flat. If you cannot outperform gold, I don't even want to hear about your investment thesis, because you should be outperforming gold, right? If you have the same performance as gold, and that's why when I see people compare themselves to gold, if you're not killing gold's performance, something's wrong, because you're just staying flat, right? Because this is another way to see it, Dave. If your purchasing power would remain flat, let's say they wouldn't change your purchasing power, it wouldn't increase, decrease, the gold price would be flat. It just wouldn't move, right? It'd be announced, it'd be $10. And if that $10 could buy you the same amount 100 years later, it'll still be $10, right? It's just a mirror image of the reality. Look, I could close up. I could show you this chart. This is SPX divided by the producer price index. So it's another way of adjusting for purchasing power destruction. The producer price index is essentially oil and a whole bunch of commodities, the cost of all these commodities for the producers to give you those finished goods. Well, when SPX breaks down versus producer price index, so the energy costs are going up so much high, and you have a clear breakdown line below a 7-year moving average, we're entering these cycles where it's a reevaluation for gold, silver. You know, silver, of course, I took the bottom of silver and all the way to the top, but it went up 3,500% up. In the 2000s, it went up 1,000%. But look, if you circle back from the first chart I showed you here, the purchasing power destruction, now we're not in a 2000 to 2001 type of scenario. We have a much bigger base or top. And you know what they say, the bigger the base, the higher in space. So this could really be impressive, the move that's going to come out of this. So yes, US equities, the Nasdaq, some stuff nominally could keep going up or retrace to higher, like the previous highs. But people have to stop looking at that. They have to divide NASDAQ by the price of silver, divide NASDAQ by the price of oil, divide NASDAQ by the price of gold to price it in those. And if NASDAQ is not outperforming any of those commodities, you should say, why the hell? Why am I, sorry about the language, but why am I holding the NASDAQ, right? I should be in crude oil, the miners. I should be in these explorers, all these, the whole sector is going to have tailwinds.
So crude oil starting a bull run, inflation on a charge again, and breakdown of producer prices index against the SPX are three key reasons that you are hugely bullish on precious metals, and that supports your technical analysis thesis. So as you're actually looking at the pure gold and silver charts, they're suggesting that we're very close to that breakout line. And if we do, as you say, the longer the base, the higher in space, that you're actually going to have a significant bull run then in both gold and silver. Yes. Maybe you might call up a silver chart to us, because so we can have a look at how close we got on the quarterly silver chart.
I'll draw one live. Here's my silver chart right here, and I'll do the quarterly. I'll remove all these drawings. Quarterly right here. Look at that. What a thing of beauty. This thing is so the wicks, when you do on quarterly close, guys, it removes on the, look at that, those perfect bounces on the quarterly close. So when you all these wicks are intra-month volatility, you know,
so the candles that you have there, the red candles are when it closed the quarter lower than it opened, and the green candles are when it closed the quarter higher than it opened. But it's the close that counts, and the total range for the month. That's where you get those, you call them as they're known, the wicks. That's the total range. So it may go higher than where it has closes at the end of the quarter. And that's where you get that wick up. But at the end of the quarter, it has closed at the top or the bottom of one of those solid colors.
Exactly. We're so, it's crazy. This is bonkers stuff there. So if ever we get, I don't know what, like a June close with a solid candle appear, look, you're not going to get these opportunities very often there. This took 2-3 years. This base took 6-7 years. Look at this massive base took, I don't know, 10-20 years. This is some epic stuff there happening.
Just explain this to our viewers then, because we look at that total range of that, and as you call it, the wicks there, the extended wicks, that's just the noise. Why is the close so important then? Why do we focus on the close more than we focus on the highest level of that quarter?
Because you got to think about this way. Let's say a daily candle has whatever 8 hours of data in it. Weekly candle will have the body or the whole thing, but will encompass 20 days, 5 days of trading, 20 days. The longer, the higher the time frame, the more days of data is in there. But the wicks, the extremities, is not where the bulk of the trading happen. So that one has less weighting. Look, I'll put the silver chart with my volume profiling. You'll see it here. Maybe on the, I'll put on the daily just to showcase.
Sure.
There's less transactions at the tops.
At the extremes.
At the extremes. You see here, here's my volume. Okay, I'll just remove the base here. I'll just keep it here. Here, I'll let that recalculate. Here, you see that high volume node? That's where most of the transactions happen, right here.
Okay.
And I'll do it. Yeah, I'll try to visualize that. Because you always have to think, what's the aggregate of market participants' actions? Where were they? Look at, you see these wicks here, or the smaller time frame. I'll put it on the weekly. You'll see that these are just wicks on the weekly. There's practically nobody that traded here. So these are like melt up tops, it gapped up in the morning. The price just went crazy up, but it's not meaningful. The real meaningful base right now for silver is $24. You see that high volume node?
So that the closes, the opens and the closes they tend to be where much more volume is traded. So they're much more meaningful price to track.
Yes.
I suppose that's something that's also echoed in the stock markets. So they say all the big players come in just after the open, just before the close, and it's where all of the volume, so much of the volume for the day is traded. So that's So that's why you see the closes as being the most significant part of the trading range.
Silver squeeze. This was a silver squeeze. Who cares about silver squeeze? And then even if there's practically no trading here, so this is like a wick. So if ever I get a breakout above the closes, even if somebody says, well, Patrick, the real breakout line is $30, I might not care, because for me, 28, if I get a quarterly close above 28, I'm just going to run through this wick, this small amount of trading volume. Even if there's some people that were crazy or like that bought at 30 or at the ultimate peak, it doesn't really matter. It's not significant. It's like there's no, those bag holders that bought here, they're even if they decide to sell to break even when we reach $30, there's not that many, right, to hold me down, hold the price down. So it is resistance. It does exist, but it's just less meaningful. So you're able to enter lower when you understand that the close is what really matters, what really drives or augments the probabilities of the possible move enacted by that base breaking out. That's pretty much what you need. You don't need to wait for every single spike there to be overturned to go your bullish. By the time we do that, you're going to be like at $30, $32. It's like you're going to have missed a little bit of the start there.
One thing I'd like to have a look at with you, I saw it on your Twitter recently, is you had NASDAQ priced in silver.
Yes. Oh, yeah. And it lost in the dot-com bubble, guys. NASDAQ lost 95% price in silver.
Wow.
This one here. All right. So while NASDAQ has been doing a crazy rally off those bottoms, and people they're super impressed. Oh, it's bouncing off Meta's up 135%, the Bitcoin's up 90% off the bottoms. Guys, they went down 76%. Like, what are we doing now? You went down 76%. So even if NASDAQ's nominally is looking not that bad, right? It's really trying to reach, try to go back to drive to all-time highs. If it cannot outperform silver and break out do a technical breakout versus silver, that is a big warning sign for the health of the tech sector. It's telling you that you want this to happen. You want a 2013 type of breakout. You want NASDAQ to kick silver's butt and leave it in the dust and remove all doubt that the capital flows, they're heading into tech and they're leaving silver like this, right? That's what you want. So I have a wake-up line here, Dave. If NASDAQ is not able, price in silver, to go up above this wake-up line, I have a huge topping pattern here that we keep seeing over and over. NASDAQ price in copper, NASDAQ price in gold, SPX price, name all these growth instruments, all the bankers, the financials are horrible. They're all about to break down priced in all these commodities. The purchasing power, the one I showed you before, it's breaking down. This is a huge wick. The sellers coming in here on the monthly last month. So kind of telling people that even if NASDAQ nominally, they're able to print so much money and it's going up, the market has to reevaluate silver equivalently or higher to price in the destruction of purchasing power required to lift nominally these tech stocks. The market has to say, look, they're destroying so much of purchasing power. Gold, silver, oil, they reflect that, or they're creating part of it, the oil portion. That has to be repriced. So there's no, look at that. This is the dot-com bubble. We know NASDAQ today is much higher than the dot-com bubble, right? Nominally. But look, price in silver,
hasn't even reached the same
topped
level.
out in 2021 or whatever, 2021 topped out. Nobody sees this. People, oh, NASDAQ, it's made me rich. But hold on, you could have. You're not price in silver. You're not even above something you did 20 years ago, 22 years ago. It might never get back there again. So this is the reality. If there's one message we could give your viewers, they should be pricing everything in gold. Everything. Take a calculator out, divide whatever you want to buy. How many ounces is that costing me? How many micrograms of ounces of gold is that costing me? Because that's going to tell you the truth of this fiat debacle, or of they're just adding zeros right to the NASDAQ. It's insane.
Patrick, I learn something new every time I chat to you, and I'm looking forward to catching up with you again in the next quarter. And we're going to check out our quarterly closes at that stage, and maybe we'll have a different story to tell. I'm going to stick a link to your service in the description on this video. But for now, Patrick, Karim, once again, thank you.
Thanks, Dave.